Welcome to the online classroom for the module FIN3701 Financial Management. In this class, I'm going to be taking you through assignment number 1 for 2021 semester 1 and 2. The assignment looks at a number of study units in the module. It touches on capital budgeting and capital budgeting cash flows and capital budgeting techniques. The question also looks at cost of capital, WACC, weighted average cost of capital, and calculating the different sources of capital. So it's a good assignment to just practice after having covered some of the important study units in the module. In particular, let me just open the study guide just to give you a better understanding of what exactly the assignment will cover for the purposes of your studies. Okay, so the assignment actually looks at study unit 1, 2, 3, 4, and 5. Yeah, so it touches on the first 5 study units. I think the first half of the module. And the unique thing about this module is that different parts of the module can be asked together in one question, like it can all be combined. So you just need to be familiar with how questions can be asked. And the best way to get good at FIN3701 is to practice a lot of questions. So I'm just going to take you through the assignment 1 solutions for 2021 for FIN3701. Okay, so let's start looking at question number 1. So question number 1, we've been given a case study. We've been told that we have an individual who supplies personal and protective equipment. And this individual is called Enoch, and he founded the company in 2020. And in April 2020, the company successfully beat its rivals by securing a 4-year tender to supply PPE to the Gauteng Department of Health to be used by frontline doctors. We're told that the project will add revenue amounting to 2.9 million. So we're just being told a lot of information here. Royal Projects accepts projects that have a payback period of 2 years or less. So this is all important information. We're just highlighting this information, the 2.9 revenue added. So these are all important points. So in order to establish the viability of the project, market research was conducted at a cost of 190,000. Expenses involved in the project would be substantial, and new equipment would need to be purchased at a cost of 3 million. The equipment could be financed by a loan from Standard Bank at 10% interest per annum. For tax purposes, the machine is depreciated over 4 years using 40, 30, 20, 10 wear and tear allowed by the South African Revenue Services. Okay, when you see something like this, right, in the exam, 40, 30, 20, and 10. This means that in year 1, depreciation will be 40% of the installed cost of the asset. Okay. That's what it means. That will be your depreciation in year 1. And then your depreciation in year 2 will be 30% of the installed cost of the asset. So that's in year 2. This is in year 1. And then in year 3, it will be 20% of the cost of the installed asset. And then lastly, in year 4, it will be 10% of the cost of an installed asset. So that's what this means, this 40, 30, 20, 10. Okay, it's not straight line depreciation, rather depreciation will be 40% of the installed cost of the asset in year 1, then 30% in year 2, then 20% in year 3, then 10% in year 4. And then we're also told that after that, the machine can be sold at a scrap value of 48,000. Okay. And then we're told part of the cost of the new equipment will be offset by the proceeds from the sale of the old equipment. And then details of the current equipment are as follows. So this is the cost. The current equipment has a cost of 1 million, resale value of 300,000, and a useful life of 4 years. Depreciation, the same as the new equipment, right? The equipment was purchased 4 years ago. So the depreciation of this current machine is also 40% in the first year, 30%, 20%, and 10%. However, because this machine has already had a useful life of 4 years, it means that it's been depreciated to a book value of 0. So its book value is now 0 because it was purchased 4 years ago and it's got a useful life of 4 years. It was purchased 4 years ago. It's got a useful life of 4 years, and it was being depreciated 40%, 30%, 20%, and 10%, which adds up to 100%. So its book value is now 0, right? But we'll do calculations. Don't worry about that. I'm still just summarizing all the information. Okay, the company will also incur variable costs amounting to 6.7% of sales and fixed costs amounting to 250,000 Rand annually. The cost of capital is 12%. This is all important information. We're going to use all this information. And capital and income gains are taxed at 28%. Please note, some tutorial letters at 29% and then others at 28%. Don't worry about that. The lecturer said they'll give credit whether you use 28% or 29%. So there were some tutorial letters that were printed initially. I think they had 29% and then afterwards they had 28%, but both of these percentages will receive credit, so don't worry about that. So the use of the new equipment will result in the following changes in net working capital. So these will be the changes. So here you need to be able to identify what your current assets are and what your current liabilities are for the purposes of the calculation on the change in net working capital, which I'm also going to get at soon. Remember, inventory is a current asset. Accruals are current liabilities. Accounts payable, current liability. Accounts receivable, current asset. Cash, current asset. Notes payable, current liability. So this is just your basic accounting that you should be familiar with, hopefully. And then we are asked 3 questions. Number 1 says, explain how the 190,000 Rand will be treated in the context. Okay, there you see. Here it says 28% income and capital gains tax are taxed at 28%. And then here it says income and capital gains tax are taxed at 29%. So there's an inconsistency. But the lecturer said whether you use 28% or 29%, you'll get credit. Okay, so question 1.1 says, explain how the 190,000 will be treated in the context of royal projects and state how the annual interest expense on the bank loan will be handled in the calculations of the cash flows. 1.2, calculate the initial investment, incremental and terminal cash flow associated with the project and the replacement of the new equipment. And then lastly, 1.3, based on the net present value and the payback period analysis, state where the royal projects should go ahead with the project and replace the equipment. Okay, so we've been asked to look at 3 questions here, so we'll look at those. So first of all, we were given 190,000, which is an expense associated with market research. Right. Remember, any expenses associated with market research expenses associated with consultations, like let's say you talk to consultants before you embark on a project. These expenses like market research or consultations and so forth that happen before the actual project are known as sunk costs. Okay, these are known as sunk costs. These costs will never be recovered. If you decide not to pursue the project, the money you spent on market research and consultancies would never come back. Let's say you do your analysis and you decide, no, we won't pursue this project, right? The money you had already spent on market research and consulting and paying consultants with regards to the investment, that money will never come back. It's a sunk cost, even if you decide not to invest in the project. Okay, all these are the cash flows, like the purchase price, the scrap value, all of these are the cash flows, like the scrap value, the purchase cost, the savings. These are relevant costs because if you decide not to pursue the project, these savings and these costs will not occur, right? If you decide to pursue the project, they will occur. But things like market research and consultations, they are known as sunk costs because even if you decide not to invest, you won't get this money back. It's already gone, right? You won't get it back. It's already gone. But money like the purchase price of the new machine, like this 3 million, right? If you decide not to invest, it means you're not spending that 3 million, so you can save it. However, for things like market research and fees for consultants, once that money is spent, it's not coming back. It's a sunk cost, whether or not you decide to invest in the project. So that's what I say. Yeah, I say the 190,000 Rand is a sunk cost and should be ignored for the purpose of the capital budgeting exercise. We call that amount an irrelevant cost. It's not relevant. It's not relevant because the cost cannot be recovered. Even if you decide not to invest, it's gone. And then with regards to the interest expense, we were also asked to comment on the interest expense and state how the annual interest expense on the bank loan will be handled in the calculations for the cash flows. Now, the interest expense should also be ignored for the purpose of the exercise. The interest expense being talked about here is this interest expense associated with the loan. We were told that the company would get a loan from Standard Bank where they'll pay 10% interest per annum, right? This interest should also be ignored for the purpose of capital budgeting decisions, right? Remember, in financial management, we have two sides. A financial manager needs to make two decisions. They need to make the financing decision and they need to make the investing or investment decision, right? Capital budgeting has to do with making the investment decision. We're trying to decide which projects to invest in. The financing side has to do with how to raise money. Where should we raise money? Should we raise money in ordinary shares or should we raise money through bonds, right? When we are looking at investment decisions, as in trying to decide where to invest money, we should ignore interest expenses. When we're looking at investment decisions like capital budgeting, like what we are doing, we should ignore interest expenses. However, when we are looking at financing decisions, when we're trying to decide whether to raise money for our capital projects through debt or equity, we should consider interest expenses. We should consider interest expenses. So if this case study, this question we were doing, if it was a question associated with making a financing decision as trying to decide which source of finance to use for our capital project, we would not ignore interest expenses, we would consider them. However, whenever we are making investment decisions, we should ignore interest expenses. Okay, interest expenses do not affect the investment decision because the investment is on behalf of both the shareholders and the debt holders. So interest expense is not relevant. Okay. Then part 1.2 says calculate the initial investment, the incremental and terminal cash flow associated with the project and the replacement of the new equipment. Okay. Calculate the initial investment, incremental and terminal cash flow associated with the project and the replacement of the new equipment. Right. So for the purposes of the initial investment, you always need to remember this very important template for the exam and for any assignment. Please remember this important template. The template says installed cost of the new asset. We take the installed cost of the new asset. Then we add the after-tax proceeds from the sale of the existing asset. Then we add or subtract the investment in working capital, right? The investment in working capital, we either add it or subtract it. So we take the installed cost of the new asset, then we add the after-tax proceeds from the sale of the existing asset, then we add or subtract the investment in net working capital, right? So let's go through each of those items, right? So to get the installed cost of the new asset, it's relatively simple. You just come to your case study and then you read the information you've been given, like you go through the information you've been given. And then to get the installed cost of the new asset, right? The installed cost of the new asset, you need to look at some things. First of all, you need to look at the purchase price of the new asset. We've been told the new asset can be purchased at 3 million, right? So you take the cost price, the purchase price of the new asset, then you check to see if there are any delivery expenses associated with that new asset. And from what I can see here, there do not seem to be any delivery expenses associated with the new asset. Then you check to see if there are any installation expenses associated with the new asset. Like you ask yourself, are there any installation expenses associated with the new asset? And from what I can see, there are also no installation costs associated with the new asset. So the installed cost of the new asset is simply a sum of the cost price of the new asset, right? Cost price of new asset plus delivery expenses associated with the new asset plus installation expenses. So we do not seem to have any of those here. We just have the cost price of the new asset. So that will be the installed cost of the new asset, which is 3 million. So we put this as a negative because it's money going out. It's money going out of the company, right? The company is spending money when they purchase that new asset. After that, we need to get to the after-tax proceeds of the existing asset, the after-tax proceeds of the existing asset. Now, to determine the after-tax proceeds of the existing asset, you need to use the following approach. Okay. I've already talked about this in the notes, but I'll just talk about it again here. I've talked about it in the online classes, but I'll talk about it again. After-tax proceeds from the sale of the existing asset. Remember, to purchase the new asset, you need to to sell the existing assets to finance your purchase of the new asset. How do we calculate the after-tax proceeds from the sale of the existing asset, right? To get the after-tax proceeds from the sale of the existing asset, right, we just take the market value of existing asset, like how much can we sell the existing asset for if we sell it in the market value of existing asset. Then we add or subtract tax. That's how we calculate the after-tax proceeds from the sale of the existing asset. Okay. But sometimes tax is not given. Sometimes tax is not given. How do we calculate the tax associated with the after-tax proceeds from the sale of the existing assets? To get the tax, we simply take the market value of the existing asset. We simply take the market value of the existing asset minus the book value of the existing asset. And we multiply this by the tax rate. If the answer we get is positive, it means we have a tax expense. So it means the answer that we're going to get when we substitute it here, we will put it as a negative. If the answer is positive here, when we calculate tax, it means we made a profit. So we have a tax expense, right? So we subtract it when we are now calculating the after-tax proceeds. However, if the answer we get is negative, it means we have a tax gain. It means we have a tax gain. It means that we sold the asset for a value which is less than the book value. So we get a tax benefit, and that negative answer for tax, we add it here. But we're going to go through all of this. Don't worry about that. And then lastly, sometimes we are not given the book value of the existing asset. Sometimes we are not given this, and we have to calculate this. And how do we calculate the book value of the existing asset? To get the book value of the existing asset, we just take the installed cost of the existing asset. We just take the installed cost of the existing asset minus the accumulated depreciation. Yeah. So this is it. If you master this, you will never have a problem with calculating the installed cost, calculating the after-tax proceeds from the sale of the existing asset. So now let's go back to our solution and just see how we can finish that off. Yeah, there we go. So, like I said, the after-tax proceeds from the sale of the existing asset is simply equal to, like remember the template I was just giving you, it's simply equal to the market value minus the tax, right? And then we were not given the tax, we were given the market value in the question, right? We were given the market value. We were told that the existing asset can be sold, the current machine can be sold for 300,000 Rand, right? So that's the selling price of the existing asset, the market value. However, we were not given the tax associated with the sale of the existing asset. So we have to calculate the tax. To calculate the tax, remember we said the after-tax process from the sale of the existing asset is going to be simply the market value plus or minus tax. And then I said sometimes we're not given tax. And I said to calculate the tax, we can take the market value of existing asset minus the book value of existing asset times the tax rate, right? So in this case, we can take the market value of the existing asset, which is 300,000. Sorry, this is just a bit of a shortcut. So I'm taking you through how I actually got this 216. We can take the market value of the existing asset, which is 300,000. We can take the book value of the existing asset, which is 0. I'll explain why it's 0. And then we can multiply by 28%. If we say 300,000 minus 0 times 28%, we get 84,000, right? And then since the answer is positive, it means we have a tax expense. We made a profit, so we need to pay tax on that profit. So it means we're going to subtract. So we then come back here, we take the market value of the existing asset and then we subtract that tax expense and we get 216,000. So that's how we got these after-tax proceeds from the sale of the existing asset. Someone will ask, how did you know that the book value of the existing asset is 0? And we know that the book value of the existing asset is 0 because the asset has a useful life of 4 years and the asset was purchased 4 years ago. So the asset has already lived through its entire useful life. So it's been depreciated to a book value of 0 because it has lived through its entire useful life. However, if the useful life was 4 years and we were told that the machine was purchased 3 years ago, then we would still have a book value. We would still have a book value. That's when we would now take the installed cost of the machine, right, which is 1 million, and then we would subtract the depreciation for year 1, which is 40% of 1 million based on the schedule. The depreciation for year 2, which is 30% of 1 million. So this is year 1 based on this schedule. And the depreciation for year 3, right, which is 20% based on the schedule. So we would add these. This would be the accumulated depreciation. I'm just assuming as an example, let's say we had been told the machine was purchased 3 years ago, meaning it still has 1 year of life, then its book value would not be 0. And then 709, so we would say 1 million minus 900,000, giving us 100,000. So this would be the book value. But in this case, in the example that we're doing now, we are clearly told that the machine was purchased 4 years ago, so it's been depreciated to a book value of 0. So that's how we get the after-tax proceeds from the sale of the existing asset. And then the after-tax proceeds from the sale of the existing assets are positive because this is money coming into the company. Okay, and after-tax proceeds from the sale of the existing asset, it's money coming into the company, so we put that as a positive. The installed cost of the new asset, we put that as a negative because it's money going out of the company. And then lastly, we need to calculate the investment in net working capital. The investment in net working capital is relatively simple. You simply take your change in current assets minus your change in current liabilities. So it's just important to identify what your current assets are, what your current liabilities are. You add the changes in the current assets minus the changes in the current liabilities, right? So for us in this particular case, let's just identify where each of these amounts came from. The 50,000 Rand is associated with the inventory. That's a current asset. So actually we can just write it here, change in net working capital. We said change in current assets minus change in current liabilities. Inventory is a current asset, inventory is a current asset. Accounts receivable is a current asset, so those are all changes. Cash is a current asset, so these are all the current assets. 70 plus 50 plus 5, we get 125. And then the change in the current liabilities, accruals, current liability, accounts payable, current liability, and notes payable, current liability. So we then say minus 2 plus 40 plus 15, and we get 53. Let's just double check if these are the same amounts, 125 and 53. If these are the same amounts that we got here, yeah, 125 and 53, and then we just subtract those two. Just be careful with your calculator and the signs, and then we get a change in net working capital of positive 72,000, right? So what does this positive 72,000 mean? If we get a positive change in net working capital, if we have a positive change in net working capital, it means money went out of the company. It means we spent money to purchase current assets. So a positive change in net working capital means money went out of the company, whereas a negative change in net working capital means money came into the company. It means that money came into the company. Okay, so in this case, because our change in net working capital is positive, it means money went out of the company. We spent more money purchasing current assets compared to the money that came in from current liabilities from loans. So because our change in net working capital is actually positive, it means money went out of the company. So in our template here, we subtract that 72,000. Because it's positive, it means money went out of the company. So when money goes out, we put that as a negative. However, if the change in net working capital had been negative, let's say the calculation we did here, we had obtained a negative answer right here. If we had obtained a negative answer, it would mean that money came into the company and we would add the 72,000. So that's a common mistake, and it's really important. If net change in net working capital is positive, money went out of the company, so we put it as a negative. But if the change in net working capital is negative, money came into the company. We had more liabilities, more loans. Remember, loans bring money in compared to current assets, which take money out when you're purchasing them. And then once we're done with those three, it's simply a matter of addition. Installed cost of the new asset, which is 3 million. You add your after-tax proceeds from the sale of the existing asset, which is 216,000. And then you subtract your investment in net working capital, and you get minus 2,856,000. So that's how you do your initial investment calculation. Those calculations associated with the initial investment, like they can change a bit. It's all about reading the information. Sometimes you use straight line depreciation. Sometimes you don't get change in net working capital. So it's always important to fully understand all the information you've been given, and then to solve the question appropriately based on that information. Okay. The next part of the question looks at determining the incremental and the terminal cash flow associated with the project and the replacement of the new machine. Now, incremental cash flows are relatively simple. I won't spend too much time here. Our new machine will have a life of 4 years, right? And then what we need to do, we just need to recreate the income statement. We just need to recreate the income statement to get the operating cash flow, the incremental operating cash flow. We just take our revenue subtract our variable costs, which are 6.7% of the revenue, which is just 0.067 times 2.9 million, right? We subtract the revenue minus the variable costs, we get the gross profit. We subtract the fixed cost. We were told what the fixed cost is in the question. We were told the fixed cost is 250,000 Rand annually. We subtract that fixed cost. Then we get the earnings before interest, tax, depreciation, and amortization. So we are assuming that depreciation is not included in this 250,000. It's not included in these fixed costs. Sometimes the question will say the fixed costs include depreciation. Sometimes the question will say the fixed cost includes depreciation. If the question says the fixed cost includes depreciation, then there's no reason for you to then subtract depreciation again, like what I did here. Okay. If the question says the fixed costs include depreciation, then there is no need for you to subtract depreciation again. This question did not say that, so we need to subtract depreciation by itself separately. And then remember, we are told that depreciation is 40% of the installed cost in the first year, 30% in the second year, 20% in the third year, and 10% in the fourth year. And remember, the installed cost of our asset is 3 million. So for depreciation, the first year, we simply say 40% of 3 million, and then we get 1.2 million. In the second year, we simply say 30% of 3 million, and we get 900,000. Depreciation in year 3, it's simply 20% of 3 million, we get 600,000. And then in year 4, it's 10% of 3 million, we get 300,000. So those are the depreciation expenses, right? And then after subtracting the depreciation expenses, we get the earnings before interest and tax. That's the operating profit. And then we subtract tax at 28%. We simply find 28% of these amounts, and then we subtract. Then we get our net operating profit after tax. And then we add back depreciation. These depreciation amounts, we add them back, right? And then we get to our operating cash flow. So this is the incremental operating cash flow that was asked for in the question. So please note here, we don't need to subtract anything to get the incremental cash flow, because we are told that the project will add revenue. It will add revenue. So an addition of revenue, that means this 2.9 million is incremental. The 2.9 million is incremental revenue. This 2.9 million, it's incremental revenue, okay? So it means if we use revenue that's been added, incremental revenue, it means that the cash flow that we're also going to get at the bottom is going to be a incremental cash flow. So that's really important, okay? So we can continue, but you'll see what I mean as you do more questions, revision, and practice, okay? So lastly, we are asked to calculate the terminal cash flow, right? We are asked to calculate the terminal cash flow. The template for the terminal cash flow is closely associated with the template for the initial investment. It's slightly different, but it's closely related to that. So the terminal cash flow is simply the cash flow associated with the sale. It's simply the cash flow associated with the sale of the new machine at the end of its life. So this machine that we purchased for 3 million, it's possible to sell it at the end of its life. So that's going to bring in money into the company. So that money that the sale of this machine brings in at the end of its life is known as a terminal cash flow. So we are told that the new machine will be sold for 48,000 Rand. So we need to use this 48,000 Rand to help us to calculate the terminal cash flow. Okay, so remember the terminal cash flow is simply the cash flow, the cash inflow usually that is associated with the sale of the new machine at the end of its life when you are terminating the project. Okay, so how do we calculate the terminal cash flow? We simply take the after-tax proceeds from the sale of the new asset at the end of its life. That's important. We simply take the after-tax proceeds from the sale of the new asset at the end of its life. Compare that with what we did when we were calculating the initial investment. We took the after-tax proceeds from the sale of the existing asset. Whereas now for the terminal cash flow, we take the after-tax proceeds from the sale of the new asset. Okay. How do we get the after-tax proceeds from the sale of the new asset at the end of its life? Okay. Again, here it's a bit of a shortcut. I just want to show you where everything is coming from, just so you follow. So here, let's rub this part out, and let's say after-tax proceeds from the sale of the new asset at the end of its life. That's important. At the end of its life. Okay. How do we get the after-tax proceeds from the sale of the new asset at the end of its life? We simply take the market value of the new asset at the end of its life, and we add or subtract tax. Okay. Sometimes you're not given the tax. How do we calculate that tax? To get that tax, we simply take the market value of the new asset at the end of its life. That's important. The market value of the new asset at the end of its life minus the book value of the new asset. The book value of the new asset at the end of its life. And usually the book value of the new asset at the end of its life will almost always be zero. Remember, we said when we've gotten to the end of the life of an asset, its book value will be zero, right? And then remember, once you subtract these two, if you get a positive answer, it means you have a tax expense. So we will subtract it in this part of the calculation. We'll subtract the tax in this part of the calculation. However, if you get a negative answer for the tax calculation, it means you have a tax gain, and we will add it when we are doing this calculation to get the after-tax proceeds from the sale of the new asset at the end of its life. So let's actually see how we would approach that in the question that we had in the assignment. Let's just actually see how we would approach that. Okay, there we go. So for our question, I just want to show you where all these numbers are coming from that I have on the screen. The after-tax proceeds from the sale of the new asset at the end of its life, we take the market value of a new asset at the end of its life minus the tax, plus or minus the tax, right? So we know that the market value of the new asset at the end of its life is 48,000, but we don't know what the tax is. So how do we calculate the tax? To get the tax, we simply say the market value of new asset minus book value of new asset at the end of its life, okay, times the tax rate. So in this case, it will be 48,000 minus 0, because we've gotten to the end of the life of the asset, its book value is now 0, times 28%, which is 48,000 minus 0 times 28%, giving us 13,440. And then since the answer is positive, it means we have a tax expense. Because the answer is positive, we have a tax expense, right? If it was negative, it would be a tax gain. So we need to subtract this amount. So we say 48,000 minus 13,440, 48,000 minus, and then we get 34,560. 48,000 minus. So that's how we got this 34,560. So this is money coming into the company after tax as a result of selling the new machine at the end of its life. Okay. So that's how we got this value right here of 34,560. Okay. And then the last part of the calculation associated with the terminal cash flow is the recovery of net working capital. It's the recovery of net working capital, right? We need to add the recovery of net working capital. Remember, initially, we said money went out when we calculated the initial investment. We said money went out as a result of an increase in net working capital, right? At the end of the project, that money that went out, that 72,000, is going to come back. So we need to add it back as part of the terminal cash flow calculation. That 72,000 that went out initially is going to come back at the end of the project, and we need to add it back as recovery of net working capital. The project is now finished. The 72,000 that we used initially to purchase net working capital is now coming back into the company, and we need to add it as part of our calculation for the terminal cash flow. Please note, let's say that right here, assume that, let's say at the beginning, the change in net working capital was actually negative, right? And remember, we said if the change in net working capital was negative, that would mean that money came in. We wouldn't have put a negative here. Rather, we would have put this as a positive, the 72,000, right? And then if, this is just an example, if we had put, if we had added the net working capital because money was coming in, if we had put it as a positive here, that would mean when we are doing the terminal cash flow calculation, we would have to put it as a negative. It means that that gain, let's say we had a gain in net working capital at the beginning of the project. Let's say it wasn't minus 72, but it was plus 72 because we had a negative change in net working capital. Let's say we had a negative 72 here, right? Meaning money actually came in as a change, as a result of change in net working capital. That would mean that when we are now doing our terminal cash flow calculation, that money that came in would now be going out. So we would now put it as a negative. Okay, that's just the alternative. But for this particular example that we're doing, initially money went out as a result of net working capital because our change in net working capital was positive. Yes, so money came out at the beginning. So at the end of the project, that money is going to be recovered. So it's going to come back. So our terminal cash flow here will simply be the sum of the after-tax proceeds from the sale of the new asset plus the recovery of net working capital, giving us a terminal cash flow of 106,560. And then the final part of the question is relatively simple. It's simply calculating NPV and IRR, which you should be familiar with your financial calculator. Part 1.3, calculating NPV. As long as your calculator is on the right settings, you put the installed cost of the new asset as CF0. That's money going out at the beginning. CF1, CF2, CF3 are simply your operating cash inflows. The last operating cash inflow, you add your terminal cash flow, right? You add your terminal cash flow to the last operating cash inflow. We use a discount rate of 12%. As we have been told in the question, the cost of capital is 12%. Then redshift pattern NPV, depending on the calculator you're using, and you get 3,255,925. So this is the NPV. Okay. The trickier one is the payback. You were also asked to calculate the payback. The question says, based on the net present value and the payback stage, whether Royal Projects should go ahead with the project and replace the equipment. Now, to calculate the payback, what you do, you need to listen really carefully here. To determine your payback, you take your initial investment, right? And then you add the operating cash inflow associated with the first year. For us in this question, the operating cash inflow associated with the first year was 2,104,104. So you add that. And then you check to see the answer you get. So you say minus 2856 on your calculator, and then you add 2104104, and then you get negative 751,896, right? And then after doing this, you check to see if this amount is greater than this amount. Is 751,896 is 751,896 excluding the negative. If ignore the negative, right? Is 751,896 greater? Is it greater than the year 2 cash flow? Is it greater than the year 2 cash flow? If it is, then you can stop. It means you can now calculate your payback. But if it's not, you need to continue taking this negative, then you add this one, then you get the next balance. Okay. So the idea is, when you're using this approach, take your initial investment, add the year 1 cash flow, determine the balance. Is the balance more than the following year's inflow? If it is, it means you can stop. However, look at this example. Let me just show you another example. Let's say our initial investment was 200,000. And then let's say year 1, we had 60,000, right? And then our balance would be, this is just my example, our balance would be 140. And then let's say in year 2, we have 80,000, right? Then we say 140, negative 140 plus 80,000, we get negative 60, right? Right? And then let's say year 3. So you see, we keep continuing because the balance is more than the next year's cash inflow. Here we have a balance of 60. Let's assume in year 3 we just have 40,000. Sorry, let's assume, so this is year, the balance is it's 40,000. Sorry for that. Let me just try to remember. I think I had put I was just showing you an example. I'll just try to put that example again. I think I had put 200,000 as the initial investment, if I remember. And then I had said, imagine that in year 1, we get a cash inflow of 60,000. And then I had, initial investment. Then I had said the balance would be 140. Then I had said, imagine that in year 2, we get So this is a negative balance. We add, we say minus 200 plus this. Then I said in year 2, imagine we get a cash inflow of 80, right? And then let's say the balance is 60, right? Okay, so I was just trying to illustrate to you how you can calculate the payback. Suppose we have a project where the initial investment is 200,000. And then suppose in year 1, we get 60,000 coming in. So if we say minus 200 plus 60, that gives us a balance of 140. And then let's assume that in year 2, we get a cash inflow of 80 coming. So clearly we can see that 80 is less than 140, right? The money coming in is less than what is still outstanding. So we have to continue. So we say negative 140 plus 80, then we get negative 60. And then let's assume that in year 3, we get 100,000 Rand coming in. Now, 100,000 Rand is more than 60,000. So the moment the cash that is coming in is more than the money that's good, that's on the balance. The moment that the cash coming in is more than the money that's on the balance, it means we can stop. And then we can calculate our payback, the number of years to get back our initial investment. We can then say our payback is going to be 2 years plus 60,000 over 100,000, which would be 2.6 years. It was just an example. So that same approach can be used. That same approach can be used in this question that we're doing to calculate the payback. We can use that same approach. Initial investment is 2,856,000. Year 1 inflow is this amount, 2,104,104. If we say minus 2,856,000 plus 2,104,104, we get 751,896 as the balance. Then year 2, we've got 2,020,104. And then since the inflow in year 2 is more than the balance, we can stop. You see here, we just had to do it once, but in the example that I showed you before, we had to go up to year 3. But here we can just stop at year 2 because the year 2 inflow is more than the balance. Then we take the year before the last year that we write. So we say 1 year plus the amount on the balance, which is 751,896 divided by the year 2 inflow, which is 2,020,104. And then if you use your calculator there, you will calculate a payback of 1.37 years. So in this question, we were told that the company will only accept projects if they have a payback of less than 2 years, right? We were told that the company will only, I saw it somewhere. Okay, I think I did not see that. Let me just double check the information given. Okay, there it is. We are told Royal Projects accepts projects that have a payback period of 2 years or less. Okay, so in this case, because we calculated our payback of 1.37 years, which is less than 2 years, we would say that they should invest in the project. And based on the NPV, they should also invest in the project because the NPV is positive. Remember, if our NPV is positive, we should accept the project. So in this case, using both capital budgeting techniques, both the NPV and the payback, we would recommend that Royal Projects go ahead with the project. Firstly, because the NPV is positive, and also because the payback calculated is less than the 2-year hurdle or target payback. Okay, so I think we can end there for today. It was a long class, just taking you through question 1 only. I hope the class was helpful. In the next class, I will take you through question 25 to question 2, which has 25 marks. I don't think we'll take too much time on this, and then hopefully I'll also be able to look at question 3 and question 4. If I can't look at those, I might have to create another class. So it might have to be 3 classes going through assignment 1. Okay. Otherwise, thank you very much for listening and going through the class. I hope it was helpful. You can keep going through the class over and over again just to cement your understanding. As usual, if you have any questions or any queries with regards to any of the concepts covered, please feel free to let me know. I won't always be able to get back to you promptly, but I'll try to do so as soon as I can. Thank you very much, and all the best with your studies.